Hi and welcome to Economics Revision class. In this particular session, I'll be dealing with June 2018 final exam for CA 1.3. So CA 1.3 June 2018 final exam. So let's see how we are going to deal with this particular question paper. So CA 1.3 Business Economics for Zika. Question 1.1, which of the following is not part of the factors of production? We have four factors of production: land, labor, capital, and enterprise. Land, labor, capital, and enterprise. So one among the options that is not part of those factors of production is choice. So the correct answer there is A, option A. 1.1, correct answer is A. 1.2, which of the following will cause a movement along a demand curve for a good? The factor that influences demand that results in a movement along the demand curve is the change in the price of a good. Only the change in the price of a good causes movements along the demand curve. All the other factors that influence demand will cause shifts of the demand curve. So meaning that the demand curve will change its position when other factors that influences demand change. But only the price of a good, change in the price of a good, will cause a movement. So the correct option for 1.2 is option A. So under both perfect competition and monopoly, a firm so a firm is a price taker if the firm is a monopoly. The firm is a price taker if the firm is part of the perfect competition. It's operating under the perfect competition. Then the firm is a price maker if the firm is a monopoly. So monopolies are price makers. So it's not always that perfect competition firms who earn pure economic profits. They may earn economic profits at the start, but because of competition, the economic profits will be competed away. Economic profits are simply abnormal profits. The part D, set marginal cost equals to marginal revenue. Marginal cost equals to marginal revenue. Okay, so at the point where marginal cost equals to marginal revenue, that's the profit maximization point. And so all firms under perfect competition will have the profit maximization point, and that's the point where marginal cost equals to marginal revenue. Monopolies will also have profit maximization points where marginal cost equals to marginal revenue, and that's the point at which both firms will wish to operate at. So the only thing that is common between perfect competition and monopolies is that both of them will try to produce at the profit maximization level of output, and that's the point where marginal cost equals to marginal revenue. So the correct option for this question is option D. Option D. 1.4, the value of the monetary or credit multiplier is given by. Now this one you just have to know the formula. Credit multiplier is 1 over the required reserve ratio, the bank's reserve ratio. So the correct option is option D on that one. Option D. Let's move on to 1.5. 1.5. The following are features of the free market economic system except, so features of free market economic system. Main aim of production is to pursue profits. That's okay. That's fine. It's a feature of perfect competition, free market economic system. Then state ownership of productive resources. No, that's not a feature of free market economic system. Actually, when you're looking at economic systems, you are looking at who controls the resources and who makes economic decision between the government or state and private individuals or private sector. So in a free market economic system, it's the private sector that makes economic decisions. The private sector is in ownership of the economy's resources and makes those economic decisions. In a command economic system, that's where you have state ownership of the resources and the state or government makes economic decisions. So free market economic system, it's the private sector that makes those decisions. So the correct option for 1.5 is option B. Option B. 1.6. Cost push inflation is caused by, okay, so cost, we have three different types of inflation, majorly three different types of inflation. Of course, there are other types of inflation. We have the demand pull inflation, which is the inflation caused by too much demand. Demand is exceeding supply. We have monetary inflation, which is the inflation caused by too much money in circulation or increase in money supply. Then we have cost push inflation, which is the inflation caused by the increase in the cost of production. Increase in the cost of production. So resources costs. You see, resources, these are factors of production. Resources are things we use in production. So if the cost of the resources goes up, the cost of labor, capital, and of course you can include land, it goes up, you are going to have inflation. So the correct option for the cost push inflation is C, which is the resource costs increase. 1.7. Which of the following correctly describes the supply side policies? So supply side policies, you're talking about the monetary policy. The monetary policy. So monetary policy instruments or tools, these policies that are aimed at shifting the aggregate supply. That's why they are called the supply side policies. Policies that are aimed at shifting the aggregate supply in the economy. So the correct option for 1.7 is C. 1.8, opportunity cost is, by definition, opportunity cost is the benefits forgone in the next best alternative. What you are giving up for you to get what you want. So the correct option there is opportunity cost is the next best option given up as a result of choosing an alternative. So best option given up as a result of choosing an alternative. So the way we describe opportunity cost is if you are choosing between mutual things, when you choose this one, you have to forgo some benefits in terms of what you could have chosen next if you were given an option to choose that. So the next best alternative. The correct option for 1.8 is option C. Number 1.9, an improvement in technology causes. Now, an improvement in technology will result in efficient production. So an improvement in technology will cause firms to supply a large quantity at any given price. Now, there are some factors that influence supply and some factors influence demand. The factors that influence demand include the price of a good, price expectation, price of related goods, things like advertising, increase in population, etc., even the quality of a good or customer preferences. Factors that influence supply, you have things like the price of a good, price of related goods. You also have price expectations there. You also have technology, the cost of production, and stuff like that. So technology will influence supply rather than demand. So the correct option for 1.9 is option C. 1.10, which of the following constitutes the canons or qualities of good tax system? The qualities of good tax system includes things like equity, okay, economy, conveniency, and certainty. Certainty, convenience, equity, and economy is the correct option there. That's option D. So option D is correct on that one. Let's move on to section B. Question 2. For CA 1.3, you always have the question 2 as a compulsory question. So let's read through the question. Due to current shortage of salaried employment in Zambia, Jacob has decided to be self-employed. His grandfather has allowed him to use his small holding to earn a living. Given the scarcity of resources, Jacob can either use the land to grow crops, rear pigs, or rear free-range village chickens. He has decided to go for free-range village chickens, chicken rearing. Suppose during his first 2 months of operation, his price or his ripe chicken can be sold at 1.5. So his ripe chicken can be sold at 150 per live chicken, and the cost structure is as tabulated below. So we have that. So what's the question? The question is complete the columns for total cost, total revenue, and profits. Then how many chicken must Jacob sell in order to maximize profits? In the short run, how much will be his maximum economic profits? Then at how many chickens does Jacob need to sell in order to break even? To break even, you are making 0 profits. Then explain how his decision to rear free-range chickens represent the 3 fundamental economic problems of scarcity, choice, and opportunity cost. Scarcity, choice, and opportunity cost. Okay, so what we're gonna do is we can transfer this information where we can type in something. So let me go to the worksheet there. So this section B, question 2. Okay, section B, question 2. A table that has got at least 6 columns. Okay, so there we are. So the data that we have includes output in quantities, total fixed cost, and total variable costs. So quantity, the total fixed costs, and the total variable costs. So quantity ranges from 1 probably up to 5. 1, 2, 3, 4, 5. Fixed cost was 100. So fixed cost 100. The fixed cost is the same regardless of the level of output. Then the total variable costs. Total variable cost starts with 120. Then we come to 200. total variable cost, then 290. The next one is 430, 290, 430, and 590. So 430 and 590. So let me just show you that these figures are all coming from the question. Okay, so that's the question that we have. So 120, 200, 290, 430, and 590. So then we are asked to calculate the total cost, the total revenue, and the profits. Total cost and total revenue and the profits. So we need total cost, total revenue, and the profit. Okay, so total cost is equals to fixed cost plus variable cost. Total cost is fixed cost plus variable cost. So you had the fixed costs which are standing at 100 plus the respective variable costs. So 100 plus 120, that will give you 220. 100 plus 200, that will give you 300. 100 plus 290, that will give you 390. 100 plus 430, that will give you 530. 100 plus 590, that will give you 690. Total revenue is the quantity multiplied by the price. Total revenue is the quantity multiplied by the price, and we are told that the price of a live chicken is 150. So if the quantity sold is 1, the total revenue will be 150. If the quantity sold is 2 times 150, total revenue will be 300. 3 times 150, total revenue will be 450. 4 times 150, total revenue will be 600. And 5 times 150, total revenue will be 750. So total revenue is simply the price multiplied by the quantity. The price multiplied by the quantity. Then the profit equals total revenue minus total cost. Total revenue minus total cost. So 150 minus 200, you are going to have a negative 70, and that means if you sell one chicken, you will make a loss. Sell one chicken, you make a loss. 300 minus 300, that's 0, so that's the break-even point. That's a break-even point where the profit is 0. Then you have 450 minus 390. Do the 450 minus 390. That will be 450 minus 390. That will be 60. So there the profit is 60. Then you have 600 minus 530. The profit is 70. Then you have 750 minus 690. 750 minus 690. Again, you have 6. So the output level that is giving the maximum profits, as we can see, the profit 70 is the maximum profit. So max output of 4 chickens. When you do the 4 chickens, then you have the maximum profits. So looking at the other questions that are asked, let's go back to the question and just reflect on those. So to complete the table, we've done that. How many chickens must Jacob sell in order to maximize profits? We've seen that the maximum profits is the 70, and so he must sell 4 chickens in order to maximize profits. The answer there is 4 chickens. Then how much would be his maximum or maximum economic profits? The maximum profits will be 70. That's what we had calculated on the table. So the profit will be 70. The next question, at how many chickens does Jacob need to sell in order to break even? Break even is where you make 0 profits. So he needs to sell 2 chickens. 2 chickens, you will be able to break even. And then explain how his decision to rear free-range chickens represent the 3 fundamental economic problems, such as scarcity, choice, and opportunity cost. So let's explain some of these. Scarcity means resources are not enough. Scarcity means limited resources. So scarcity means limited resources. So now, what's the name of this guy again? Jacob. Now, Jacob had to make a choice because the father gave him a small holding, which is not enough for him to rear chickens and do other things on the same piece of land. Can't rear chickens and also do other things. Listen to line number 3, scarcity of resources. Jacob can either use the land to grow crops, rear chickens, rear pigs, or rear free-range chickens. Now, land is scarce. The plot is not enough for him to grow the crops at the same time rear chickens, at the same time rear the pigs. So because the land is not enough, the land is limited, he has to make economic choices. So choices are made necessary because of the limitation of resources. If he had plenty of land, there would be no choice. He can do all the 3 economic activities. But because land is not enough, land is scarce, he has to make choices. He has to make choices. So choices has to be made in regard to how to use that land, what to produce on that land, and how to produce, and of course who will consume that. So choices are made necessary because of scarcity of resources. So you can say choices made necessary are necessitated choices are necessitated because of or necessitated by scarcity. So scarcity makes choices necessary. Then every time you make a choice, you incur a cost, because in making a choice, you are saying you choose this one and you have to forgo some other benefits. So the benefits forgone in the next best alternative is what is called opportunity cost. So opportunity cost arises because of benefits forgone. Benefits forgone in the next best alternative. So in the case of Jacob, he has to give up the profits he was supposed to make either by rearing pigs, or he has to give up the profits he was supposed to make by growing crops. Because he's now using land for chickens and he can't grow the crops or he can't rear the pigs. So that's how scarcity, choices, and opportunity cost play out in the story of Jacob. So let's continue with our work. Now we come to question 3. According to Rostow, development requires substantial investment in capital and less developed countries to grow. The right conditions must be created. The government of Zambia, under the Vision 2020, seeks to develop the Zambian economy towards the status of a prosperous middle-income country by 2030. As industrialization increases, externalities of production and consumption also increase, and the socially efficient level of output and price would be at a level where external costs were taken into account. So required, describe the 5 stages of development of industrialized economies according to Rostow. So according to Rostow, there are 5 stages of development in industrialization. So stages of development, this is question number 3. So let's go stages of development. All right, so the first stage is the stage that is called the traditional stage, the traditional stage, or traditional society, traditional society. Now, traditional society was highly dominated by subsistent production. Subsistent production is where families were producing just enough for them to survive. There was no surplus production for sale, so there was no trade. Mainly, people were producing just enough to feed their families. And if any form of trade arises, it was the barter system that used to work. Give me what you have, I give you what I have. So that's the traditional stage or traditional society. Then we came to second stage. It's called the transition stage. The transition stage, or the precondition for takeoff. The transition stage, the precondition for takeoff. So at this stage, people were producing at least sufficiently enough. They would have surplus for trade. Surplus for trade. There was some kind of an increased specialization because now trade was kicking in, and people would produce more than what they need for their consumption, so that the extra can be traded with other individuals. And at that stage, we also saw the base of the transportation sector. The transportation sector, because now there was an idea of trading, so transport needed to be available for people to move their produces to another place for sale. That's what's called the transition stage. Then stage number 3 is the takeoff stage. The takeoff stage. Now, under the takeoff stage, there was increased industrialization and a shift from agriculture to manufacturing. Increased industrialization, a shift from agriculture to manufacturing. This is where we saw the base of manufacturing, and people were not just relying on their agricultural produce, but manufacturing started taking place. Then the fourth stage is the stage called the drive to maturity. The drive to maturity. So the drive to maturity, here we saw the base of diversification. People started diversifying to other productions. So we saw the base of a wide range of products, because now people are switching to other productions as well. Now the final stage there is what is called the high mass consumption. High mass consumption stage. The world could be at this stage, high mass consumption stage. Under this stage, we see the base of the service industry. The service industry. So high consumption stage. We see the base of the service industry at that point. The service industry was based at that point. Okay, so those are the 5 stages according to Rostow. Let's get back to our questions and see what else is required of us to do there. The next question says, distinguish the term negative externality from positive externalities. Now, just to talk about externality in general, externality means the spillover effects from transactions, the spillover effects from transactions. Those things that affect the third party that are not involved, that are not primarily involved in transaction, are called externalities. So these externalities can either be negative externalities or positive externalities. For example, you buy a big radio cassette and you play it loudly, of course you paid for that radio cassette, but when you play it loudly, even the people, your neighbors that were not part of this transaction between you and the shop where you bought that radio cassette, they get to be affected. So that spillover effect from your transaction is what is called externalities. So externalities can either be negative or positive. So how do we explain negative externality? Negative externality occurs when the marginal social benefit is less than the marginal private benefit. Marginal social benefit is less than the private benefit. So you benefit more than what society is benefiting from. That's a negative externality. The positive externality occurs when marginal social benefit is greater than marginal private benefit. Marginal social benefit is greater than marginal private benefit. That's a positive externality. Now, let me give you examples of negative externalities and positive externalities. The other way of looking at negative externalities, you can talk about negative externalities in terms of cost, meaning that the marginal social cost is higher than the private cost. The marginal social cost is higher than the private cost. That's a negative externality. Positive externality, marginal social benefit is higher. Positive externality, marginal social benefit is higher than the private benefit. So examples of negative externalities: smoking in the public. When you are smoking in the public, you are inconveniencing other people that are around that vicinity. They are bearing a higher cost as society as compared to your cost or how much you spent buying that cigarette you are smoking. The exhaust that comes from your car, which negatively impacts society, is a negative externality. You are eating bananas, you throw the banana peels anyhow, causing pollution. That's a negative externality. Positive externality, you get the education. When you get the education, the entire society will benefit in a bigger way. So that's positive externality. You put security lights around your house. Even the community or your neighbors will benefit from your security lights. That's a positive externality. So positive externality talks more of the benefits that come to society than your private benefits. Now, outline any 3 policies the government can put in place to deal with externalities. 3 policies government can put in place to deal with externalities. Obviously, government dealing with externalities is focused on minimizing the impact of negative externalities. So one of the things government will do to deal with those externalities is by charging taxes. It's called a polluter pay tax. You charge a tax to the firms that emit or cause pollution. When you charge a tax, you are making the cost of production for them to go higher. Probably that will force them to reduce on the levels of production, and that will reduce on the levels of emission that they release or pollutants that they release. So now one way is to charge a tax to the polluters. Number 2 is to subsidize methods of production that minimizes pollution. If there are technological methods of production that firms can use, and these do not emit a lot of pollutants, what government can do is to subsidize those methods of production in order to encourage firms to produce more efficiently and reduce the levels of pollution. The third one is where you can give pollution permits. Pollution permits is where you give firms an allowance to pollute to a certain extent in a given period of time. And these pollution permits are tradable in the sense that firms that can minimize or reduce on pollution are able to sell the pollution permits to other firms that cannot minimize pollution. That advantage of selling a permit will cause some firms to take deliberate action to reduce on pollution so that they can benefit by selling the permits to other firms that cannot reduce on pollution. And the very fact that this is a pollution permit, so it has a limit it has a limit to which firms can pollute. So firms are not allowed to pollute anyhow, but they pollute to those limits. So 3 factors or policies that government can put in place. Number 1 is charging taxes. Number 2, subsidize methods of production that minimizes pollution. Number 3, give pollution permits, which limits the quantity of pollutants that each firm is allowed to emit. All right, that question is done, so we can look at question number 4. So inflation is an economic condition in which aggregate prices are always increasing in the country. The value of money is falling. Inflation is nothing but too much money chasing too few goods. For example, in Zimbabwe, the inflation rate a few years ago was too high at more than 1,000%, and in turn required a bag full of money to buy a loaf of bread. And the value of the Zimbabwean dollar was very low in the market, and money supply in circulation was too high. Inflation, if not properly managed, can be dangerous to the economy of any country and the business community in that country. So explain any 3 causes of inflation. Now let me go to our answer page and talk about briefly the causes of inflation. Causes of inflation. What causes inflation? Causes of inflation. Number 1. Before I talk about the causes of inflation, I need to explain what inflation is. Inflation is the fall in the purchasing value of money. A fall in the purchasing value of money. That's what inflation is. What causes inflation? What causes a fall in the purchasing power of money? Other people may explain inflation as the increase in the prices of goods and services, but we talk about inflation as the fall in the purchasing power. And the reason why the purchasing power is falling is because the prices are going up. So, number 1 thing that causes inflation is increase in the cost of production. Increase in cost of production. When the cost of production goes up, you have inflation because prices will go up. So if there is an increase in the cost of labor, increase in the cost of capital, increase in the cost of land, those are factors of production, you definitely are going to have inflation. And this type of inflation is going to be called the cost push inflation. Cost push inflation. Number 2 cause of inflation is demand. Increase in demand, or demand being higher than supply. When demand is higher than supply, you have prices of goods and services going up. And this is called a demand pull inflation. So demand pull inflation. Inflation has gone up because of the demand. Number 3 is too much money in circulation. Too much money in circulation. When an economy has got too much money in circulation, and that can be caused by lower interest rates. So too much money in circulation will cause inflation. It will cause prices of goods and services going up. So those are the 3 major causes of inflation. Of course, there are other causes of inflation, such as import inflation, inflation caused by increase in the prices of imported goods, inflation caused by increase in the wages, which we call wage inflation, and things like that. But the major causes of inflation is the increase in the cost of production, increase in demand where demand surpasses supply, and increase in money supply where you have too much money in circulation. Let's look at the next question. It says, briefly explain how commercial banks also play a role in creating money supply to the economy in a country like Zambia that may cause inflation. Inflation caused by money supply, obviously the banks, the commercial banks, play a critical role in that. Why? Because commercial banks make loans, and these loans create deposits, and money supply increases, equivalent to the amounts of loans. So when commercial banks are giving out loans, they are increasing the quantities of money in circulation by issuing. So if commercial bank issue a lot of loans, it means that people are going to have a lot of money in circulation, and that creates a high money supply that will cause monetary inflation. Monetary inflation is the inflation that is caused by too much money in circulation. Explain 3 measures that a central bank in any country can put in place to control money supply that may cause inflation. Now, money supply causing inflation is where you have too much money in circulation, and so the central bank should have measures that reduces money supply. So the following are the measures that reduces money supply. So I'll say measures to reduce money supply. That's how the central bank can deal with monetary inflation. Measures to reduce money supply. Number 1, you have to deal with the OMO. We call it OMO, open market operations. Open market operations. Now, to reduce money supply, open market operation is where the central bank participates in buying and selling of securities, government bonds and government treasury bills. So that's the open market operation. So for the government to reduce money supply in circulation, government should sell securities. So sell securities. Sell securities. That will reduce money supply. Number 2, you have to deal with the discount rate. Discount rate. So what should government do with the discount rate? First of all, what's the discount rate? This is the rate at which commercial banks are allowed to borrow money from the central bank. It's the borrowing rate for commercial banks. So when commercial banks borrow at that rate, they also lend us money at an interest rate. So the interest rate is influenced by the discount rate. So to restrict the quantities of money that goes in circulation, government must increase the discount rate. Increase the discount rate. Increase the DR, discount rate. What happens when you increase the discount rate? Interest rates will increase. What is an interest rate? It's just the price of money. So if the price of money go up, it's costly to borrow, and people borrow less, and there will be less money in circulation. The third thing that government should do is to increase banks' reserve ratio. Commercial banks' reserve ratio. So what's the reserve ratio? The reserve ratio is the percentage of deposits that commercial banks are supposed to keep in reserve, not to be lent out. So when you increase how much commercial banks should reserve, it restricts on how much commercial banks can give out as loans, and that restricts the amount of money that goes in circulation. Simple as that. So let's look at the next question. So we've dealt with that question. Now explain any 4 limitations of the monetary policy. Now, the monetary policy is limited because of the following factor. Number 1, money multiplier varies. The money multiplier varies. Number 2, is the money markets. Unorganized money markets. You see, even when you are restricting the amount of money that goes in circulation, there will be other people that will be lending. Usually it's called the underground economy, or the black market, or the dark market, you can call it. This is the market that government does not recognize, or government doesn't even know about it. Then you have non-banks offering loans, because the restriction is on the banks to offer loans or restrict the quantities of money that banks lends out. But there are also other non-bank institutions, such as insurance companies, that may offer loans. That's a limitation as well. Then the time lag itself is a limitation, because it takes time for these policies to take effect. All right. So those are some of the limitations that you have on the monetary policy. At this point, I'll end here. I will do another video to finish up on question 5 and question 6. This is because, like I say in all the videos, this is because we want to keep the videos a little bit short. Not too short, but a little bit short, because we don't want these videos to be too long. That may become exhausting actually to watch them. So I want to end here for now, but look out for the next videos. We are supposed to do about 4 different question papers, and after that we will say you are ready to go in the exam and write that particular exam. So all the best as you prepare to sit for this exam, and God richly bless you.